How to get rich with other people's money, also known as OPM. So today I'm going to talk about how a lot of the investors who keep buying properties, and if you're wondering how they do it, they use it by using other people's money. So I'm going to talk about the secrets of becoming rich with other people's money. So the best way to show you how people make money or how to use other people's money is to give you an example. So I'm going to go through an example, and coincidentally, it so happens that the next couple of days, I'm going to be listing a duplex for sale in Orange County. The duplex, let's take an example. I'm going to be listing it for $800,000, and I'm going to take you step by step on how to borrow the money and how it benefits you as the investor. So let's say we buy the property for $800,000. Obviously, you need a down payment. Most of the investors that I know or I've worked with put at least 20% down payment to get a loan from the lender or the bank. I also know that some of the investors, when they have another property or they have a business or a commercial property or even another rental house, they borrow from that house or even from their own house, which is called a HELOC loan, home equity line of credit. So let's assume that for your down payment, you borrowed 20%, which is $160,000. So that was step one of borrowing the first down payment of $160,000 from your HELOC or from other sources. Step number two is before you can close escrow, you need to get a loan of $640,000 after you put 20% down. So to get the 640, you're going to go to the bank, most likely, or a lender. Some people may go to private lenders if they have bad credit, but let's assume you go to a bank. And in today's world, April 2020, rates are hovering around 3.75 to 4.25%. So for this example, let's take a loan at a rate of 4%. So if we take a loan of 640 at 4% fixed for 30 years, there's going to be principal, interest, taxes, and insurance. So let's go through what the numbers are. And I have a little cheat sheet here, so I'm not wrong on the numbers. So on a 640 loan, $640,000 loan, your principal and interest payment per month will be $3,055. Then you have property taxes. You can pay that every month, or you can pay it every twice a year. So let's assume we're gonna pay it every month. And in Orange County, the tax rate is 1.1% of the purchase price. So the monthly property tax comes out to $760 a month. Or the homeowner's insurance, which is required by lenders, comes out at $67 a month. And there is the PMI insurance. In this case, the private mortgage insurance will be zero because you put 20% down. And that's why when I mentioned that a lot of investors buy at 20% down, one of the advantages is that if you put 20% down, you do not have a private mortgage insurance. At the same time, you are dropping your monthly payments. So there's a double advantage of putting 20 or more percent down. So the total for the PITI for this property for $800,000 comes out at $38.82 per month. And I mentioned to you that this is a duplex as an example, and in fact, reality, it is a duplex. And it's a 2-bedroom, 1 bath and 2-bedroom, 1 bath. And the current rents that my client has, he's getting $2,000 a month rent for each unit. So the total is $4,000 a month income. So if you look at the cash flow, the cash flow is $118 a month. $4,000 a month income, $38.82, which leaves you with $118 a month cash flow. By the way, if you have any questions or if you have any comments, I would appreciate it if you comment below and also like and subscribe as we go on. I would really appreciate it. So in conclusion, I want to tell you 3 things that the investor in this case borrowed. The first, he borrowed the down payment, zero out of pocket, assuming he got the HELOC loan. Number 2, he borrowed the loan of $640 from the bank, which is a big advantage. And number 3, what I would like to mention to you is the landlord is not paying the $38.82 a month. Guess who's paying those those mortgage payments for the landlord, the two tenants are paying for it. So the landlord technically has zero out of pocket in buying this $800,000 property, which is a pretty good investment. But let's look 15 to 20 to 30 years ahead. Well, let's jump to 30 years ahead. And this is why you may want to buy investment property, because as you know, wealth built, the fastest way to build wealth is through real estate and time and other people's money. So let's say it's 2050 today. Assuming that we have 2 to 4% increase in property values, I'm assuming, I didn't calculate, but I'm assuming that this 800,000 property, if you keep it for 30 years, first of all, it'll be paid off in 2050. So you have zero payment on it. You will be getting rental income. And if it's $4,000 a month today, 30 years from now, I'm assuming it's $15,000. Let's say it's $12,000. That's $12,000 a month you will be getting when you retire. That's a lot of cash flow. The other advantage is this $800,000 property will be worth, at least, if I had to guess, $2 million or more, at least in Orange County. So you're buying an $800,000 property, you're putting zero down, you're paying zero mortgage, technically, and when you retire, you have $15,000 cash flow, it's worth $2 million or more. What a return on income. That's how rich people make money or investors make money. And if you're a beginner, or if you would like some information on how the other processes are in buying property or rental property, feel free to call me or contact me for a free consultation. This is just one way, but there's many other ways which I can talk to you about. Again, if you have any comments and questions, please note below. Thanks for listening.